Good evening, ladies and gentlemen. So, the door closes to the elevator, goes up to 3, and the door opens again, and you see the third floor is conference rooms. And you see, conference room A, conference room B, conference room C, conference room D. You see this big sign hanging right on the other side of the elevator that tells you which conference room is being used, who's using it, what time it's scheduled, and everything else. Door closes there, and it goes up to the roof. Opens up there, and you see a big open area. Lots of tables and chairs. You see coffee machines and vending machines, and you see all the balcony doors that open outside where all the smokers can go smoke. Door closes back on the elevator, and you go all the way down to the basement. And the doors open there, and you see it's maintenance. So there's no underground parking there. It's just a maintenance office. You can see, the cages where the cleaning equipment's kept. You see a sign that says maintenance manager, and you'll see some lockers, and the door closes again. Okay. Well, now you've done some of your analysis for the markets. Now, the concept of support and resistance is similar to that elevator. The floor below your feet is what is supporting you. Each time you need to move up to the next floor, you need to break through that ceiling. When you break through that ceiling and get up to the next floor, that ceiling now becomes the floor under your feet and becomes your support level. And you got to break through that next ceiling again to get to the next level. If the elevator is coming down, it's just the opposite. Now, since we've used some observation now, we can start making some intelligent decisions. First of all, by knowing the time of day. And like I said, we got off the subway, got up, came up in this building, went to the Starbucks, and we could see this ground level was very, very, very busy. Only because lots of people were running, getting their coffee, getting their bagel, getting their croissant, getting whatever, before they went over to work. Now, it's still early in the morning, so we know there's not going to be much traffic on that elevator to the second floor. There's not going to be much traffic on that elevator third floor, maybe some odd and end traffic to the roof. So most places it's going to stop is going to be where? This time of day. Most of the time the elevator comes up, it's going to stop here because we're going to slowly get a dwindle in of employees coming to work. Now, once they've come to work, we know we're going to see an increase in travel up to the roof deck because a lot of those people coming into work are going to go up to the roof to smoke their cigarette. And like I said, there's coffee machines up there, a place to sit. So they'll go up there for their morning cigarette. They'll go up there and have their morning coffee. And then they'll come back down. So most likely that elevator is going to come down to here. Or it's going to drop somebody off up there and come down to here to pick up more people to take them back here. And this is really how price moves. Okay. By understanding and looking at the calendar and the schedule on the conference room, we know when that elevator is to start moving up and down to that conference room floor. Similarly, we know based on the economics calendar what time of day major economic events are going to go on. So all of this helps us analyze price action. So regardless of whether we're looking at a strong uptrend, a strong downtrend, or a medium turn or congestion, we can use simple concepts like this to evaluate how price should move and where it should move. So support and resistance is one of the most widely used concepts in trading. Strangely enough, everyone seems to have their own idea on how you should measure Forex support and resistance. Now, the concept of support and resistance forms the basis of technical analysis. Traders look to buy at or near a significant level of potential support in an uptrend, or sell near or at a significant level of potential resistance in a downtrend. So in other words, when that elevator is moving up, you're looking to buy to continue going up. When that elevator is looking to come down, you would like to, when it's coming down towards that significant floor, like once you broke through 3 and you're coming down to 2, you like to trade going down because the odds that it's going to go down to the ground level are important. Now, you must have heard the old business cliche, buy low and sell high. Traders usually ask the question, how low is low and how high is high? One way we can quantify these levels is using areas where price has stopped and changed direction. The area where price stops after moving up and then turns around is called resistance. Resistance acts as a ceiling, capping the future advance of price. Resistance is not just some random area where price turns around. There are potential sellers, traders who have sold an asset once before and remember the collective power of that they had to push price lower. There are also buyers who went long at support and were disappointed that price did not go higher and will close their positions if the sell orders at a particular resistance level. Now, for instance, we've seen Bitcoin the last few days take a real beating. It was trading all in the mid 6,000s for the last couple of weeks, and it's dropped steadily down to the low 4,000s. Now, when Bitcoin starts to recover, we're going to remember or be able to look at areas when it came down where it got congested, where buyers and sellers kind of stuck. As it goes back up to the 6,500 level, we would expect that level to hold. We're not expecting Bitcoin to rally and go much above it. So when it comes up to that level where it was before it had this big break because of all of these ins and outs with this new fork, okay, we would expect the price to come back to where it was. So as it's moving back up to its resistance level, which would be the highest level it was trading at recently, we would be looking to exit the market if we had bought it as it was recovering. So another group that makes up resistance are the ones that bought at or near resistance and are trapped when price fails at resistance. Now, any which direction we're going to move price takes a lot of work. For price to continue up in an uptrend, it's a lot of work. It takes a lot of buyers buying continuously. It's not an easy thing. Same thing with a downtrend. And what most people don't realize is most of the time, price is in congestion, a sideways trend. Well-developed uptrends and downtrends don't happen all that long, often. But what happens is price moves up. Okay, as price is moving up, it's going to hit a resistance level, a place where the price had a difficult time in the past getting through it. This is created by a lot of times the buyers who bought here at this level and are taking their profit at this level. They said, they set out in the beginning, this is how much profit they went, and they start selling. Also, a lot of buyers who are sitting on the sidelines saying, oh, that price is getting a wee bit too high for me to buy. I'm going to wait till it gets a little bit lower before I buy into that market. So as it hits there and you have the sellers selling off because they're taking their profit, the other buyers moving sideline, the price eases down. Okay. What happens is it eases down enough, those buyers jump back in the market and they start pushing the price back up. So that becomes a level of support that supported this price above it. Again, as price eases back down, we would expect it to come to the prior support level because that's what supported the price. That was the floor below their feet. And it'll move back up. So doesn't this look like an elevator moving up floor by floor by floor by floor by floor by floor? And each time, and what happens is each time this support is broken, it then becomes a resistance because when we come back on a downtrend, That support will be our resistance lines. So one thing to remember is that support and resistance levels are not exact numbers. Okay? Oftentimes, you will see a support and resistance level that appears broken, but soon after, to find that the market was just testing it. With candlestick charts, these tests in support and resistance are usually represented by candlestick shadows. Now, there are many ways to get these support and resistance levels. Because again, it's the floor and ceiling above price. Because you can't get in that elevator and push it up and ride it up and down and do the observation. We have to have ways to get these support and resistance levels. And one of the most cumbersome, but one of the best ways to get it is through what I call eyeballing. And that is actually by looking at price and making observations, just like you did in the elevator. Now, one of those handouts that I gave you, support and resistance indicators, explains all this in detail, but I've prepared a video presentation I'm going to share with you right now on eyeballing. And we're going to show you how to get and how to find these support and resistance levels easy enough in your charts. So I'm going to pop that up on your screen, and then we'll go on after you watch this short presentation. So as you can see, it is a manually intensive process. But locating these swing lows and swing highs can be serve many purposes. First of all, it makes you interact with price charts and price action. So you become a little bit more involved. The second part is these are levels you've looked for. Now you can have major support levels, minor support levels. And just because of the time frame, they don't disappear. So if you start out with, say, a 1-day chart and fill those in, but we're trading a short term, half-hour charts because we're trading short-term CFDs, and we want to trade from a half-hour chart, you can then move to an hour chart and then really define some more support and resistance zones. And then you can move into a half hour and really define those down. And so you can call your longer term majors and then your shorter term minors. And you can even use color coding to let yourself know where those levels come from, and they will extend forward. So once you've got these on your charts, as long as that asset is staying within that overall price range you set it for or that you built them for, you don't have to keep building them over and over again. They're just there. And you can just keep pulling them forward. Now, arguably, the easiest support and resistance levels to add to your chart are called pivot points. Now, pivot points are a little bit odd because pivot points come from mathematical calculations, and they're calculated based on the current open, low, and close of the price. And you use a pivot point calculator to calculate. So they're not going back and looking at any price movement or any history. And they're simple mathematical calculations. You can get them using a pivot point chart that's available free of charge everywhere. They're all the same. So don't think you're going to go find one that's different or better, because a pivot point chart just does the calculations. Also, whether you're going to investing.com or Forex Factory or FX Street, all the places that offer you technical analysis will also publish a pivot point chart that's continually updated. And what a pivot point chart looks like is just what I have up on your screen. Oh, here we go again. Okay. Now let's try getting my marker back on here again. There we go. Okay. And we're looking at the classic, and you can see it's going to give us the 3 floors, hypothetically, or the 3 support levels underneath of us, and the 3 resistance levels over and the current price. Now, these numbers are continually changing. And when you go to get these, a pivot point calculator is going to ask you whether you're looking at a half-hour time frame, a 1-hour time frame, a 2-hour, to do the calculations. And they're constantly being updated as price moves. So you can draw these on your charts, but they aren't not static because they are constantly changing. So you need to get them on your charts in the time frame you're looking to trade. But remember, an hour or two later, they're not going to be as valid anymore. Okay, because they're only calculations based on where the current price is and what the price movement has been. But they also work quite well, which is very odd, but they do. And lots of people rely on pivot points. And most charting systems, even the ones on Alvexo, will give you an ability to just click on your pivot points and it'll drop it right on your chart for you. You don't have to look them up and draw them. Okay. So the market ebbs and flows. They go up, they come down, they move sideways. The primary way we make sense of these movements are analyzing the price action as well as the levels in the market where price bounced higher or rotated lower. We call these support and resistance levels. Support and resistance levels form the foundation of technical analysis. Now, for me, I tell everybody, let's forget the word technical analysis, let's call it chart analysis. There are some basics you have to be able to do. You have to be able to read a chart, put a trend line on a chart, and put your support and resistance, no matter how you're going to trade. If you're a fundamental trader and you're only going to trade from earnings reports on Apple, you still need to put these pieces of information on your chart, because no matter how you make your decision to trade, okay, if you're going to trade only the dollar when the central bank says it's going to raise interest rates, that's perfectly up to you. That's your strategy. But how do you know what price to enter the market, what price to get out of the market, where to put your stop loss, and did the price already come up higher than what you expected? So it's already got the increase built into it. Okay. You're only going to get this from charts. And your support and resistance levels will help you get your stop loss, your take profits, calculate your risk management, and give you entry and exit points. Because if the price of an asset comes down and hits that support level and bounces off of it, that's a good time to enter. You wouldn't want to trade it when it's getting near the resistance level. You'd want to see how it reacted to that resistance level. So you might think that a hypothetical stock is going to go high and keep going up, and it went to 32, 32.10, 32.20, 32.30. But you can look at it historically. 32.90 was a very difficult price for that stock ever to break. Every time it got to 32.90, it bounced off of and came down. Well, when you look at that, would you want to enter that market at 32.85 because you think it's going to go up, or would you wait till it got to 32.95 and broke that resistance level to see if it had the momentum to go up? So we talked about traditional swing highs and swing lows, as we saw on the presentation, of finding your support and resistance levels. Now, these levels that we find by zooming out to longer time frames, typically weekly charts, possibly even monthly, this is where we get a bird's eye view of the market and the major turning points within it. These levels do not have to be exact. Now, remember, you're going to draw them on your chart at a number. Okay? But that number is just a zone. Okay, it's just an alert area, because these numbers are not definitive. They're not finite. Okay, they give you areas of information. They give you points that you need to be looking. So you consider this the first step in regards to support and resistance level. It's the first thing you should do when analyzing your charts. Now, have you ever heard the old saying, old support becomes new resistance? This is referring to the phenomena of the market making higher highs and higher lows, or lower lows and lower highs. Because price moves in an uptrend, it pushes and ease, pushes and ease, push and ease, push and ease. And these form the higher highs and then the higher lows, the next higher high and the higher. And you can determine when it's making these pushes and eases, when it pushes up here to price, and then you see it ease back down, you would expect it to ease back down to the next major support level to bounce back off of. If it breaks through it, you might be looking at a reversal instead of a continuation. And it helps you diagnose whether you have a good trend or a trend is about to reverse itself or move into consolidation. Now, these levels are good entry points as well as points to define risk and stop loss. You can place your stop loss on the other side of these levels. For example, in the chart image over here, we see a clear downtrend in place. As price broke down past the previous support levels, that level flipped to the resistance level and acts as a high probability entry level if price retraces back above them. We can look to sell or buy at swing points even if they are not part of a trend. Markets spend much of their time consolidating and in trading ranges, so you'll be able to find trades within these market conditions, not only in trends. We can simply use the most recent swing highs and swing lows to define our next trade, which can help us, as we see in this example on this chart. Now, we also mentioned earlier dynamic or non-static support and resistance levels. These come from moving averages. Now, you can use, like my personal favorite, which are 21 and 50 period moving average. You can use moving average crossovers. You can use as a single moving average, and as price breaks that moving average, they become levels of support and demand. So here's an example of the 50-period EMA. So we can see how this crossovers, whenever price crosses that moving average, that's forming your new levels of support or resistance, depending on which direction you're using. Now, also we have what we call our 50% retracement. Now, a lot of people mix this up with Fibonacci because the Fibonacci tool adds a 50% retracement level to it. But Fibonacci, 50% level has nothing to do with Fibonacci. It actually comes from Dow theory. And it's a proven phenomenon that markets might often hold the halfway point of a previous move and then bounce back up to its original direction. Now, this is partly a self-fulfilling fantasy, but that 50%, if you can see an uptrend and go down to 50% of it, that becomes another support level or resistance level, depending on which direction you're moving. There's lots of ways to get these different support and resistance area, zones, prices. So here we had, this is the previous move, and we might see price retrace 50% of this previous move. So as price came down, it came down to that 50% level, and that acted as a support level. We see price bounce off of it, come back down again and retrace 50%, touches it again and bounces straight back off of it again. So that becomes an important support level because it supports the price above it. So now that you know the basics, it's time to apply these with other technical tools. Now, one of the key ways to interpret your support and resistance levels is combining it with volume. As price approaches a significant support and resistance level, and you're expecting price to break through it or bounce off of it, you should be able to look at the volume. If we see price come down to that level and volume starts to increase, buying volume increases, we're going to see it bounce off. If it breaks that level, okay, especially if it breaks that level with a lot of significance, a lot of momentum, we should see also selling volume increase. Okay. And there's other ways. We have the bounce and where we see price come down to the support level, bounce off of it, and then move back up. So what we might do is use that as a buy point. And we would set our entry or order entry price after it came down and give it a little bit of time to bounce off of it and wait to see if volume's increasing and then enter as a bounce off. And we would put our stop loss slightly below that support line so that if it moves back down and that support line doesn't hold it and it starts moving against us, we'll get closed out of the trade. We also have the break. And in the perfect world, support and resistance levels would never fail. They would work all the time, but we don't have a perfect world. But also McDonald's would be healthy for you, and we'd also fly around with jetpacks. So in the perfect Forex trading world, we could just jump in and out of whenever price hits those major support and resistance levels and earn loads of money. But in reality, that doesn't happen. The fact of the matter is that these levels break often. So it's not enough just to play the bounces. You should also know what to do whenever support and resistance levels give way. And you can play it the aggressive way or the conservative way. The aggressive way is to, the minute it breaks that line, enter going, in a short position or the opposite direction and trade and set your stop loss above that previous support level. The conservative way, which is a smart way, is wait till it breaks that support level with some significance, bounces back up, but can't break above that support line. So now it's becoming resistance, and then enter your order when it bounces off of it coming back down and set your stop loss above the resistance line. But it's your choice. You decide which works best for you. Now we've gone over major types of support and resistance and how to interpret these with our elevator trading and how I use them as an indication of market conditions, levels to look to buy or sell from, levels to define risk and as a framework to understand what the market has done, what it is doing, and what it might do next. And that's very unique about support and resistance level. They give you 3 clues: what it has done before, what it's doing now, and what to expect next. Well, that's a lot. That's a lot of information you can get. And it's not very complicated. It's not big mathematical calculations. And when you combine a solid understanding of support and resistance levels with price action and market trends, you have the triumvirate of trading. So support and resistance doesn't have to be confusing. We can mix and match any of the methods and create a healthy amount of price levels in which we can trade. As always, practice makes perfect. So make sure you test out these levels and use a real-time demo account. Use the Alvexo demo account. Try them out. Combine them into your trading. And remember, if you want to see these little presentation videos, you can find it at the link I gave you there. Otherwise, thank you very much for joining us tonight. Thank you for supporting Alvexo. And please download those handouts because they'll explain everything in great detail for you. And we'll see you again real soon. Thank you very much and have a great night. Bye now.